in this next run, but gold moved first. And the reason is that more people know about gold, it's more broadly held. And I think that people, I think the gold is very good at quote unquote smelling future monetary debasement. And if you look at the conditions we're in right now, it's very clear to anyone with a calculator.
Large cryptocurrency investors and analysts are certain that there will be a breakout in the next weeks, despite the fact that Bitcoin and other cryptocurrencies have been trading in the same range for months. They predict that Bitcoin will eventually surpass its peak and keep rising until it hits 6 digits. According to supporter Lawrence Lepard, Bitcoin might hit $100,000 before the year is out. He is optimistic about the future and is certain that this is possible. Larry and other proponents of the top cryptocurrency believe that the U.S. presidential election in November will mark a significant and long-lasting shift in the value of Bitcoin and other cryptocurrencies. The well-known portfolio manager predicts that Bitcoin and all digital assets will experience an immediate spike in demand and a huge price explosion if pro-crypto former President Donald Trump wins the election in November. The reason for this is that investors won't have to be concerned about rules preventing them from making a large investment.
And the GDP growth isn't growing, they need GDP growth to be faster than the interest cost, than the underlying. So they need negative real interest rates. Is what I'm describing. And if they don't have them, there's going to be another point in time at which the lines cross and things break. And so it's a little hard for all of us to know that. And I know for Bitcoin, it's a little frustrating because you've kind of been trapped in this, downward trending wedge, between kind of 65 and 55. But, gold smells it, which I think is pretty interesting. I mean, as you're aware, and gold is hitting record highs. And what I think that is, and this, by the way, this is what happened in the 2018, 19, 20 period too. Gold broke out from 1365. Bitcoin just sat there. And then ultimately Bitcoin went racing by gold, which is what will happen this time too. Bitcoin will outperform gold massively in this next run, but gold moved first. And the reason is that more people know about gold, it's more broadly held. And I think that people, I think the gold is very good at quote unquote smelling future monetary debasement. And if you look at the conditions we're in right now, it's very clear to anyone with a calculator that, we are going to face serious future monetary debasement, whether it be in a month or in 6 months or a year, it's coming. In my mind, that's what's going to happen. I think when things break, gold's going to go through 3,000 and Bitcoin's going to go to 150, and easily in my view. Because they both represent sound money. I mean, one is old and analog and tired and widely distributed. The other is new and growing and therefore has a lot more upside because of, the low level of adoption. I mean, I'm always, Crisis Bitcoin on Twitter always has that. I'm always amazed at the chart where still the entire Bitcoin market is only $1 trillion in the context of $900 trillion of financial assets in the world. I mean, we're talking just a real sliver of the amount of money in the world is invested in the soundest asset in the world. And so, as time goes by, more and more people are going to come to realize that this is the soundest asset and they're going to adopt it. And it's, that disparity is going to close, right? I mean, Bitcoin's market cap is going to be much higher than it is right now. True, but the game is afoot and things are accelerating. The gap between, 08 and 2020 or 2019 was smaller than, the one before that, and the printing size of each round is larger, and the issues are getting to be more obvious, and more people are becoming aware of them. And so, but yes, you're right, and we don't know how it plays out, and it's all you can do is say probabilities. I mean, we could have a kind of a quasi melt-up boom where the stock market making new highs, unemployment being relatively low, businesses being relatively healthy, the debt level continuing to grow at all levels. Everyone just keeps on leveraging themselves up. And, I think that's a possible outcome. But I think if we do have that outcome, it's going to be inflationary. I mean, I think one thing I think is true is we saw the first, we had peak deflation in March of 2020, right? That was kind of, when the 10-year sold at 60 basis points briefly, that was a really deflationary impulse. And since then, we've gone the other direction, and at various points in time and at various speeds, right? When they printed 40% of the money supply, well, inflation took off, and now they put the brakes on that, and so inflation has calmed down. But I think it's very clear to me that inflation is going to heat up again. And, you're already starting to see it when China, as we're doing this right now, China just came out with a big stimulus package in the last 2 weeks.
For many years, sound money supporters like Lepard have been saying that the U.S. needs an austerity program that would help cut government spending and the deficit. During election season, politicians almost always say they have a long-term solution to the problem and will make changes as soon as they take office, but that never happens. Even people inside the government like Fed Chair Jerome Powell are starting to admit that there is a problem and that urgent solutions are needed. Powell says that politicians need to have an adult conversation about the debt situation, but we all know that won't happen. Instead, they will choose the easy way out and keep spending. Printing and debasing money until it falls apart is why Lepard thinks supporting hard assets like Bitcoin and gold is so important for our survival as a country and maybe even as a species. Here are some more clips from his talk.
Where, they decided they're going to support their banks, inject money into the economy. I mean, kind of all the above on the money printing scale. And, the day that happened, I think, commodities, tin, rubber, various other commodities that are traded in Asia, they were all limit up on the day. I don't think there's any doubt that the governments will try to keep the system functioning. And if the release valve is inflation, so be it. The economy's going, ticking along, but it's inflationary. I think there's a possibility though that they lose control of that inflation on the next one, and that's really the issue. The issue is, we're in a period here where we're shifting from everyone believing in the deflationary trend in the stock market, which we had for 40 years, and the correct choice was always to quote unquote buy the dip. Because really, if you bought from 2008 onward, if you bought the dip in the S&P, you've been rewarded. It might have been painful when you did it, but you've been very, very well rewarded. And that's all because the overall deflationary trend was in place and interest rates were lower, so stocks were the best alternative. I think as we've turned the corner here on that issue, and you see it other places too, like you've got this potential dock workers strike, and labor all over the world is realizing that their purchasing power just got destroyed by 40%. And guess what? They want to share. They're like, okay, you want to keep the economy running? That's great. You're going to increase our salaries a lot. And, the dock workers want 60 to 70% over 10 years. Well, even if you take that divided evenly and say it's 6% a year, that's a lot more than 3. So we've entered an inflationary world, and in my opinion, and so that's what's going to, ultimately create the problem, because the government has to sell bonds in order to finance these deficits, and they want lower interest rates, and so they will. I think Powell's going to continue to chop rates. I think he's going to take them down 50 at the next meeting and 50 at the meeting after that, because he knows that with federal debt the way it is, that the $1.2 trillion run rate on the interest cost is just destroying the budget, and they've got to get that down. Now they're going to get it down in the form of doing more short-term bills. Because no one wants to buy the long stuff. And so, where I ultimately can see this going is as this inflation gets worse, the bond market is going to continue to sell off, and maybe even the stock market starts to have some trouble because, the margins start to get squeezed, labor's pushing costs up, and the consumer's not exactly thriving, and so they can't, the higher prices, they buy less. And so, and when the stock market rolls over, then it's kind of game, set, match on this whole thing, because there's a lot of wealth effect there. That's where a lot of tax income comes from. And, the U.S. government's running fiscal deficits of about 6 or 7% of GDP. And in the 2000 crisis and the 2008 crisis, when those occurred, deficits went up by between 8 and 12%. So let's take the average of 10. Okay, we're running 6 already, and then we have a downturn. And so, tax receipts go down because the markets are down, and social costs go up because we need more food stamps and welfare, and so now we're running a 17% deficit. Well, that's real third world banana republic kind of stuff, and you're also starting to see in the dollar. The dollar is just about to break through 100, which is kind of a critical support level for a long number of years here, and so I think the release valve is going to be lower dollar and higher inflation. And, the bond market, when they lose the bond market, that will be the big tell, and that will really light the fire underneath the hard money assets, gold and Bitcoin. And the reason that's the case is that if people start not buying the bonds and interest rates start going up, it makes the situation worse. As you know, that's the doom loop. That's the debt doom loop. The deficits get larger, et cetera, et cetera. So eventually they're going to have to do what they did in World War II, and they're going to have to say, hey, you know what? We're going to cap the interest rates at XYZ, or call it, in World War II, the case was 2.5%, but we're going to have to cap interest rates at 3 or 4%. And to the degree that they go above that, we're going to buy them ourselves. Well, okay, what are you going to buy them with? Well, we're going to buy them with the balance sheet and printed money. And so, so this is back to all roads lead to print or go burr. And when print or go burr, that's what creates the inflation. And so, it's a vicious cycle, that happened once before in the 70s. But, the debt to GDP then was 35%, not 125. And so Paul Volcker was able to shove rates up high enough to get it all under control. But I don't think this time they're going to be able to do that, because if they shove rates up to 20%, the entire world will go bankrupt. So
the huge changes won't occur until the market is driving everyone crazy, and even the most seasoned analysts lose faith in their own skills, despite our desire for them to happen right away. Bitcoin will soar above 6 figures after first surpassing $70,000 and then $80,000. Thankfully, the initial indications of this dejection are already apparent. In a recent social media post, Raoul, a macro analyst and former Goldman Sachs executive, appears to be the first to abandon up. Powell proclaims that bananas, which stand in for his predictions for the banana zone, are bashful fruit, and forbids himself from making any more predictions. Bananas are shy fruit, so everyone, including myself, is guessing when Bitcoin range breaks will be prohibited till further notice. The banana zone will eventually start with more posts like this, but the moment will pass almost as quickly as it starts, so hold on tight and see it through to the end.